All right, so we're going to be, in this part, we'll be looking at some activity-based costing and then some of the performance evaluation in this part. So we've got Aunt Ethel's Cookie Factory, manufactures and sells three flavors of cookies: macaroon, sugar, and buttercream. The batch size for cookies is limited to 1,000 cookies based on the size of the ovens, cookie molds, and based on budgetary projections. The information below is available. Um, Projected sales in units um, is 500,000, 800,000, and 600,000. We've got all this per unit data. Hours per 1,000 unit batch, direct labor hours 2, 1, and 1, oven hours an hour each, packaging hours a half hour each. Total overhead costs and activity levels for the year, 2,400 hours is the activity level. And they want what is the determine the activity cost driver rate for packaging costs. Okay, so the overhead costs are 150,000, and there's 950 packaging hours. So that's just 150,000 divided by 950, and that equals 157.89 per packaging hour. Using the ABC system for sugar cookie, compute the estimated overhead cost per 1,000 sugar cookies. So the so for the sugar cookie, we've got 1 hour of oven hours. So that's that one. Oven hours is 210 divided by 1,900. Is $110.53 on that. For the sugar cookie, we've got 1 oven hour, and so that would be 110.53, and we would have the half 0.5 times the 157.89, because we're a half hour up here. And that's going to equal $78 and we'll say 95 cents. So we add those two together. And so that these two added together is 189.48. There. Okay, compute the estimated profit per 1,000 cookies. So 1,000 times 750. That's our revenue minus 1,000 times 0.17, 0.15 here, 0.2, that adds up to 0.17. Minus our 189.48 that we got from here. So 750 minus 170 minus 189.48. Oops, did that backwards. 750 enter 170 minus 189.48 minus, we would make $390.52. Compute the estimated overhead cost per 1,000 cookies using a traditional system. Compute the estimated cost. So that we would have the overhead of 360,000 divided by the 2,400 direct labor hours. Would be $150 per hour. And we use per batch, we use 1 hour is $150. Cost. Commute the operating profit per 1,000 cookies. Sorry, on that. Operating profit per 1,000 cookies will be the same, 750. Revenue minus direct materials and direct labor was 170, 17 cents a piece, minus 150. Would be $430 there per 1,000 cookies. Okay. So just a little bit different way of doing that. The next one, Tiger Pride, produces two products of t-shirts, two product lines, t-shirts and sweatshirts. Profitability is analyzed below. They have they have decided to revise their current assignment of overhead to follow the information. Supervision is 130,000. 200, and that's based on direct labor hours, and inspection is 141,600 demanded by inspections. And it asks for supervision costs allocated to sweatshirts will be. Okay. So supervision costs are 130,200. The total activities demanded are direct labor hours. There's 48,000 plus 45,000 is 93,000 hours. So 130,200 divided by 93,000 is $1.40 for supervision. For sweatshirts, there are 45,000 hours, 45,000 hours is 63,000 on that. Hey, if we wanted to, let's see, we could do the profit, selling price, direct material, direct labor, that stays the same. It's this manufacturing overhead that changes. Um, so it's okay. Actually, that's the overall. I think they want per cost. So it's a 120 direct labor hours, 1.2 is $1.68 for that. So for t-shirts, it's $1.40, and they use 0.75, and so it's 105 plus the inspections. They do 70,000 inspections. So it's 141,600 divided by total number of inspections is 88,500. Would be $1.60. Times 70,000. Divided by 64,000 units would be $1.75. So we would have 280 instead of the 350 there. On this, we would have 160. Times 1850 inspections, and divided by t-shirt or by sweatshirts, it's 37,500. Be 79 cents. Be 246 for there if we do the whole thing out. Okay. Columbus Company provides the following ABC costing information: labor 450,000, 10,000 hours, gas 24,000, 3,000 gallons, invoices 180,000, 7,500 invoices, total costs. The above activities used in the three departments are lawn, bush, and plowing. How much total cost will be assigned to the lawn department? Okay, so labor, we just divide this by this. So labor is going to be 450 divided by 10,000 is $45 per hour. $24,000 divided by 3,000 gallons is $8 per gallon. And invoices, 180,000, 7,500 invoices is $24 per invoice. Okay, so now we just multiply that out. 3,000 times 45. Gas 1,800 times 8, and 1,300 times 24. $135. 14,400. 31,200. Add that all up. $180,600 will be assigned to the line department. The Antique Corporation uses the investment center concept for the museums that it manages. Select operating and data for the 3 museums are as follows: Ohio, Dallas, and Texas. Compute the return on investment for each division. Return on investment is going to be our income. So we got Ohio, Dallas, and Texas. ROI is going to be 105,000 divided by operating assets of 700,000. Is 15%. For Dallas, our operating income is 115 divided by 500,000. And that's going to be 23%. And then finally, Texas, operating income is 120,000 divided by operating assets of 600,000, and that's going to be 20%. Okay. Which museum managers do best based only on ROI? The Dallas manager. What other factors? The population area, what they have to compete against, any number of things that are you could think of. A very qualitative question. Crayon Corp has 3 divisions which operate autonomously. The results for 2020 are as follows. Compute the ROI and compute the residual income. Okay. So ROI, we've got East, West, and International. ROI is going to be the operating income, 4,500,000, divided by their investment base, 30 million. So 4.5 enter 30 divide equals 15%. For the West, we have operating income of 5 million divided by an investment base of 32 million. And that would be 15.625%. And then the international would be operating income of 5.5 million divided by investment base of 34 million. And that's going to be 16.18%. Okay, then we get the residual income on that. The residual income is going to be the operating income, 4,500,000, minus the 30 million times 15%. So 30 million times 15%. It's going to be 4,500,000, and so that is zero residual income. I'm going to drop this, stagger it just a little bit. 5 million minus 32 million, times 0.15. Is 40,800,000, so it'll be 200,000, and then this 5,500,000 minus 34 million times 0.15. 34 million is 5,100,000, so that will be 400,000 for that. Okay. And this one, economic value added, Copter Magic Company supplies helicopters to corporate clients. Copter Magic has two sources of funds: long-term debt with a market and book value of 32 million, issued at interest rates of 10%, and equity capital that has 18 million, book value 8 million. And the cost of equity capital to Copper Magic is 15%. Its tax rate is 30%. Copper Magic has profit centers in 4 divisions that operate autonomously. The company's results for 2020. So we've got New York, Chicago, Dallas, and Los Angeles. The weighted average cost of capital, couple of different ways you can do this. I'm going to take the 32 million times 10% is 3,200,000, and then I'm going to take the 18 million times 15%, and that's going to equal 2,700,000. Add those two together, 5,900,000. These together are 50 million. Divide that by 50 million. And I get 11.8% as their cost of capital. Compute each division's economic value added. And on the so for that, we got New York, Chicago, Dallas, and Los Angeles. The first thing you do is take the operating income, 1,750,000, and you multiply that times 1 minus the tax rate. Tax rate up here is 30%, so 1 minus the tax rate is 0.7%. And that is minus the assets, 11,500,000, minus the current liabilities, 2,500,000, all times the weighted average cost of capital. Okay. I should have left a little more space here. 1,750,000 0.7 times is 1,225,000 minus 11,500, 2,500,000 times is 1,062, and so $163,000 for New York. For Chicago is going to be 2,400,000 times 0.7 minus 9 million minus 3,500,000 times 0.118. This is 1,680,000. And this is 5 million. It's not right. Did something wrong. 9 million. 9 million. 3,500,000. 5,550,000. It's 649,000. 1,680,000. 1,031,000. Dallas is going to be 4,675 times 0.7 minus 27,500,000 minus 9,500,000 times 0.118 is 3,272,500. Is 2,124,000 is 1,148,500. And finally, we've got Los Angeles, which is 4,200,000 times 0.7 minus 25 minus 8 million times 0.118. Okay, 4,200,000, 2,940,000 minus 17 million is 2,006,000 equals 934,000. Okay, so it asks us to rank them. So it would be 1, 2, 3, 4, largest to smallest. All right, so that is your review for exam 2. Good luck.